Good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, November the 25th, 2025, recording this in the morning. Okay, so we've just got some news just coming across the wires that potentially Ukraine has agreed to some sort of form of deal. It seems, obviously many details have to be figured out. The Russians have to accept it, Ukrainian parliament, Europeans, there's a lot of moving parts. But it is interesting just to see the immediate market reaction, which is fairly, what sort of expected in classical. So just on a 3-minute chart here, you can see the US dollar when those headlines hit about 740 or so. You can see the US dollar weakening. So probably to the benefit of the euro, maybe things like the Polish zloty, maybe a negative also for the Swiss franc. So fairly classic sort of risk on, so to speak, or a lack of a risk off reaction. You can also see the US equities, the S&P 500 futures here had an initial bounce, but ultimately that's probably not going to affect the US equities too much. It's probably going to be more of a European story. We can also see gold initially had a sort of a sort of a fall, which I guess just a quick, sort of probably algo driven fall just on, sort of a piece dividend. Interesting is the 10-year note here. Now, of course, there's all kinds of other factors, the Fed in the US data, et cetera, et cetera. But in general, the 10-year note going up. And one of the reasons for this is that there could be some kind of sort of a lowering of inflation. We'll look at the gas prices over in Europe, which again is not nat gas in the US. But if you look at something like the TTF, we'll look at that in a second. But essentially, if energy prices are coming down in Russia, so sort of if energy prices are going to come down in Western Europe, so maybe more oil coming into the market and natural gas prices coming down, that's going to be a deflationary effect, which in effect will be good for bonds because that means that less inflation is obviously welcomed by bonds, so the yields should be going down, and that's why we're possibly seeing sort of a positive effect here in the US Treasuries. We'll look at the European bonds in a second as well. And obviously, you see a bit of a risk on here. You see the Australian dollar pushing higher just on sort of a bit of a risk on kind of sentiment. And the big one, or one of the most obvious falls, of course, will be something like crude oil. And you see here the WTI having a pretty substantial fall, although already sort of crawling back a little bit. So let's just have a quick look here and look at, on the bigger picture chart. We'll put it back onto the dailies. And again, just to put this in context, just want to have a look at oil here. Then we'll look at some of the European products. So if you look at oil here, you can see that, I mean, it's not overall in the context of things a huge drop because we've already seen a lot of this potential sort of cessation of hostilities in Ukraine. Let's cross our fingers, sort of priced into the market. And you see that oil has been pushing downwards for the last, essentially, well, you could argue it's been heavy for sort of a few months, but basically pushing down towards this level here. I think anything down here at 56 would actually be a pretty interesting buying opportunity were oil to get down to there. I'm not even sure it will get down there. And maybe if we look across at Brent, you can see that Brent, which is probably, technically a little more affected even by the situation in Russia and Ukraine, is also down at levels where there might be a bit of support. And Brent maybe more like about $60, $61 or so. So let's keep an eye out on those. But what I was talking about before is the nat gas contract for Europe, which is the TTF, the so-called TTF, Dutch TTF. And you can see here that that's been falling a lot, just sort of coming down and coming down and coming down. And just on this sort of latest news over the last few days of the potential ceasefire, you can see that's coming down. And again, the main point here could be to the benefit of bonds over in Europe. So let's have a look here at something like the Bund. And you see this is even on the daily chart. You see here the Bund pushing a lot higher. And if we bring that to the front end of the German curve, so let's say the Schatz, which is the 2-year, you can see again on the daily a nice green candle here, and on the 5-year, the front of the curve, even a bit more. So overall, that's been taken as a positive by European bonds, as I say, possibly because of the deflationary implications of having lower energy prices if the sanctions on Russian oil are relieved and nat gas prices come down. Now, in terms of the implications on the FX, there hasn't been a huge amount of sort of flow. I mean, you could argue that for the euro, this is a positive, and you're seeing here the euro, which had been getting to kind of interesting levels. And the reality is that the dollar is actually a little bit overvalued at the moment if you look at the interest rates, differentials, and whatnot. And so this is not altogether unexpected. And of course, you throw in potentially some good news or risk on. rather for the Ukraine news, that's a positive for the euro. It possibly is going to be reflected even more in a sort of higher beta sort of cross pairs, which are a little bit more focused on sort of risk and whatnot. The typical one would be euro Swiss franc, and as I've been saying the last few days, you see here the euro Swiss franc really ripping quite a lot higher. Be also quite interesting here to see the euro zloty, the Polish one, which I do like to look at just because I like saying it apart from anything. Let's have a look at the Poland. And of course, the point is that Poland, you see here the euro down quite substantially against the zloty. And now the zloty has its own issues. There could be a rate cut this week and whatnot. But the point is that as a risk barometer, euro going down against the sort of the higher beta, higher risk zloty, which of course is in Eastern Europe and obviously next to Ukraine and very, very exposed to all of that. That's a fairly typical reaction. And to be honest, it wouldn't surprise me to see a little further weakness in euro zloty, maybe even pushing down here a little bit. So that's great news if that indeed is a cessation of hostilities. Again, we're still a long way to go. So what we need to keep in mind as well is that if the Russians don't come to the party and other interested parties don't all agree on this and there are problems, we could actually see an unwind of everything we've just been seeing. So let's say the Russians don't come to the party and don't agree. Of course, we could see oil suddenly, at least on a day trading perspective, a reversal, the zloty sort of weakening, euro weakening, Swiss franc strengthening against the euro. All of these trades might unwind, at least on a day trading perspective. So let's keep an eye on those headlines, but overall, that's what's happening. Just grab some tea. Okay, just in terms of other stuff, just while on the currencies, I just want to go onto the New Zealand dollar here because, and just have a look at this. So this is the spot New Zealand dollar, and you can see here that overall we're well below any kind of fib retracement or anything like that. So if we just get rid of some of these lines, you can see here that the New Zealand dollar has really sort of taken it in the teeth, so to speak, over the last, basically 6 months or so. And you can see that from the top up here in sort of July, we can see the New Zealand dollar down almost 10% against the US dollar, and we can also see against the Australian dollar. You can see the Aussie has also had a super big run up against the New Zealand dollar. Although this, of course, it is stalling out. This is a key level. This goes all the way back. There's overhead resistance at this level here at about approximately 115-ish, something around there. And you can see that it had a nice sort of bull breakout. This again, Aussie dollar here on the daily chart. Nice bull breakout, but it did poke its head above that and has subsequently calmed down a little bit. A reason I'm talking about the New Zealand dollar is just because there's Reserve Bank of New Zealand decision. Sorry, that's the Aussie dollar. The Reserve, and you see here, for example, the Australian dollar versus the US compared to the New Zealand dollar, really, really underperforming. So it's been whacked, and that's been justified because there's been high unemployment rates, a fairly dovish Reserve Bank of New Zealand. And the economy is essentially fairly weak, and also being exposed a little bit to some of the trade sort of fallout. Although, as you can see, it did recover initially after Liberation Day. But the point is that we have the Reserve Bank of New Zealand this evening our time. They're expected to cut 25 basis points, so that would bring their cash rate down to 2.25. So think about it, 2.25. So they've actually cut already a lot. Now, what's interesting, what's going to be the forward guidance and the rate projections. The Reserve Bank of New Zealand does like to do rate projections, a bit like the dot plot in a sort of certain sense, and going to 2026. The market currently is still pricing another 42 basis points of cuts going into 2026. So that's over 2 cuts. Now, the interesting thing is whether, in the statement or the rate projections, if the rate projections are not further revised lower, maybe the market will take that earlier pricing I referred to, the 42 basis points of cuts, as being a little bit too dovish and might push back a little bit. And we could be getting to the point where, is 2.25%, assuming they cut 25 basis points this evening, is 2.25%, maybe getting to some kind of sort of terminal rate here. Maybe that's enough, going to put a floor under it. And if that's the case, you can also see the New Zealand dollar here, the Kiwi, getting down towards levels where you could argue there, maybe is just a little bit of, support starting to come down relatively soon. So I think at this point, the New Zealand dollar, if we get down towards, let's say, 55 or something like that, could be quite an interesting risk reward, maybe even against the Aussie dollar, because that's also seems to be a little bit overextended. So that's definitely something to be looking out for overnight, is to see the reaction function there in New Zealand. So let's keep an eye lookout at that. In terms of other stuff, just want to have a quick look in at what's happening in terms of the Fed. You can see here that the market is now pricing for a December cut, which is on the 10th of December, so not that far away, an 80% chance, which is fairly incredible if you compare that to we're almost back to where we were about a month ago or so, up at 91%. And of course, we had that wobble earlier on. So the question is, why is it now back there? Because we haven't really had that much data. And we'll talk about the data in a second. So if you have a look here now at 82%, and I just want to bring up also the Bloomberg, the WIRP function, snapped sort of the close of the market yesterday. And you can see here that that's saying 73, so it's a bit different to the CME. Maybe even it's changed over a little bit overnight, but basically 73, to 80% chance of a cut, almost up to 18 basis points. And if you look going out into the future, sort of the terminal rate, you can see here that the implied rate, the lowest it gets down to at this point is around about 3%. So you see 2.9, 3%. So at the moment we're at 3.88. That's the effective Fed funds rate. So the market is pricing in still, another three and a bit cuts. So yeah, you see here about 3.6, 3.7, 3.5 cuts. So about between 3 to 4 cuts, including December. So why is that? And as I said, we haven't really had too much data. So it's probably a combination that we've had Williams, as I said a few days ago, essentially saying that, another rate cut could be justified. Waller saying that he thought the Fed was still slightly restrictive. So another rate cut down to sort of some kind of quasi-neutral sort of level could be justified. And also yesterday, Mary Daly of the San Francisco Fed, put her hat in the ring, threw her hat in the ring for another cut. So it does seem as though the consensus is building for a cut, and the market has taken that. Although the point is, what I was trying to say is that we'd have to really sort of look at the data, and let's just look at the data which is coming out, because the data, as I say, it's a bit all over the place. It's a little bit piecemeal. But if we just actually have a look at it, we are expecting, it's 8:23, so we are getting some data coming up at 8:30, but we also just had the ADP. So let's have a look at the ADP. And now this is interesting because expected, last time was 2.5, so we've got a 13.5 thousand. So that's actually quite, well, it's negative, which is not good. And this is feeding into this sort of narrative that the US employment situation does seem to be weakening. So let's just have a quick look at market reaction to that. You can see here the dollar just on the 8.15. You can see here on the 3-minute chart, you see the US dollar weakening further on that. So we've had the Ukraine and then that. Interesting though, to look at the equities. The equities are taking that, let's say at 8.15 on the equities. So if we go up to the US, the S&P 500 here, you see the equity is actually liking that. And it's interesting because that seems to be saying, hey, the economy is not that bad that we need to really worry, but we will be getting probably a rate cut. So the equity market more interested in the rate cut at this point. You can see gold also is already reversed that sort of Ukraine situation and much more focused on the fact that the Fed could be cutting interest rates. The 10-year, now it's interesting, the 10-year actually is the one which didn't react too much. One would have expected the 10-year to have popped a little bit higher, but not going up quite as much. The Aussie is starting to calm down a little bit here. Oil already giving it back. So the point I'm trying to make here is that that ADP, although it's not a perfect number, and that is not going to, that's going to feed into negative sentiment. And talking about other stuff, we are getting retail sales. But again, it is from September. We are now at November the 25th. So, this is starting to become very, very stale. It's difficult to know how much the market will react to this, but it could be more of building a sort of a narrative, momentum for a narrative. So let's see what the retail sales are expected to do. The previous, the consensus is to come down a little bit versus the previous. So you see the consensus here on the headline for the month-over-month number, 0.4. Ex-auto, of course, and the control group is the one we want to be looking for. And as you can see, excluding automobiles and also the control group, which is kind of like the core, you can see that that is definitely expected to weaken compared to the previous data. But again, the caveat needs to be that this is from September, so maybe the market's not going to overreact too much. We also get PPI. Of course, inflation. Again, September is an old number; it's out of date. But if you look at the core numbers, excluding food, energy, and whatnot, month over month, that is expected to sort of attenuate down to 0.2, which of course would feed into this narrative that gives the all clear for the Fed to potentially cut interest rates. So let's keep an eye on that data at 8:30 coming up just in a few minutes. By the time I upload this, it'll be after that. So that's got to be an interesting one to look out for today. Also, let's keep an eye out for our shares in NVIDIA because there was some news sort of in the overnight session that Meta will be buying some AI sort of chips from Google. So it looks as though Google is coming up. And in a more general sense, it looks as though potentially competition is slowly starting to assert itself against NVIDIA's domination. So we could start to see some realignment in the AI space and in some of the chip makers space. Okay, guys, I'll leave it there because we're getting up towards 8:30. Have a great trading day, and we'll be back tomorrow with the macro snapshot. Thank you.